Welcome back to the Wealth Elevator. I'm going to be talking about some tax strategies and I'm going to be breaking it down and going a little bit advanced into negating passive income, ordinary income, throwing these terms around like passive income, ordinary income, depreciation, passive losses. If you don't know what it means, that's okay. I'll catch you right back up. We'll start the basics. A lot of these are strategies that myself and a lot of our folks in our communities have been doing for quite a while. I've been investing in real estate since 2009 and been using a lot of these tax strategies to lower my taxable income. The two income buckets that we have here are ordinary income and passive income. Now, ordinary income is the easy one to understand. I think that's what a lot of us get. When I was an engineer, I had a W-2 salary. Some of you guys are working more as a small business owner, consulting. So those will be ending up on your 1099s. Either way, both of these are ordinary income. Now, passive income is different. It's the income that you derive from rental properties or other real estate syndications. Basically, you're not clocking in and out to do this work. You're not trading time for money, which is essentially where we all try to get to once we start to get on this wealth elevator, which by the way, we're going to having a retreat coming up here in Hawaii in January. So if you're new to the group, we'd like to see you out there. Okay, so now that I got the basics out of the way, ordinary income and passive income, think of it as two buckets. Now, this is the part that trips people up. When you invest in a real estate deal, the property produces something called depreciation. So depreciation is something that the IRS lets the partnership write off the cost of the building over time. And this is nothing magical here. I've been doing this on my little single family homes back in 2009. When with single family homes, you're able to deduct 1/27th of the value of the building improvement, not the market price, the building improvement over 27 long years. But what's cool about these syndications or these partnerships is you can speed up the way you write it off and enact something called bonus depreciation. Basically, it's just the regular depreciation, but only faster, which you can get through these commercial syndications. These write-offs add up over time and they flow onto the K1. The K1 is that one-page form that you get from a lot of these deals where the depreciation flows to you as an equity holder. This paper loss is what we call a passive loss. This is where you're getting your passive losses. Now, passive losses can only offset passive income. So if you have a rental property producing income, you can only offset that income. If you do not have passive income yet, these passive losses do not disappear right away, right? They stay on your 8582 form as suspended passive losses. So you can use it in the future when you have more passive income. They simply roll forward until you have enough passive income in the future to be able to offset. Or another thing that happens is, say you sell that property, you can fully unlock those passive losses to offset that taxable sale. So this is why when people with a small portfolio of rentals or they have a handful of multiple K1s, they start seeing the tax benefits right away. They also have passive income for the passive losses to work against. Now, there are some restrictions to what passive losses do. Of course, you should always consult with your own CPA on this, but we'd like to give you a basic understanding of this so you can have an educated conversation with your professionals. If you guys need a referral, always go to thewealthelevator.com/vendor. And there's some folks that we've worked with in the past there that sort of understand this stuff. But unfortunately, a lot of the basic CPAs out there don't really want to get into the weeds with this stuff, nor do they understand it themselves, nor are they investors themselves like how we are. This is where a lot of beginners and a lot of CPAs don't understand. Now, passive losses cannot wipe out your W-2 income or 1099 income, your ordinary income bucket. They cannot wipe out your business or consulting income. That is ordinary income, and that's why the IRS keeps these two buckets separate. Now, some people hear that they can claim the real estate professional status, which solves this bit of divide, right? But this truth is a little bit more complicated. You're going to need to work with your CPA to mitigate this. A lot of times you're going to need to meet certain time requirements so that you can materially participate in the actual activities. And most limited partners, LPs, and syndications do not qualify, which means their losses stay passive. Now, reps can be powerful, but it's not a quick fix and it's a lifestyle choice because some of my clients are still under a couple $1 million net worth. Those are the people that need to make a lot of income and pay a lot of taxes, unfortunately. But if you're come to that point, getting to the second, third floor of the wealth elevator, maybe above $2 or $3 million net worth, when you can start to rest on your laurels a little bit, maybe your family is a little bit more grown up, past the college age with your kids, maybe you can start to think about working less and maybe one of the spouses can be a real estate professional so you can get a little bit more efficient with your taxes. but every situation is different. For most beginners out there, the simple takeaway is that syndications live in that passive bucket. They're great for building passive income, but they're not really designed to eliminate your job income. If you stuck around this far, you're probably wondering, all right, when does this start to get good? And here we get a little bit more advanced, but we have to walk through the steps first, right? Use passive losses to offset passive income in syndications or rental properties. And then maybe you can start to qualify for rep status to offset it. For most of our clients, we find that they still work their day jobs and they're not going to do real estate professional status. So what did they do? This is where other investments such as oil and gas come into play. Some structures can be put in place where you can create deductions that work against ordinary income. And I'll say that again, not just passive income, but ordinary income. Want to do a little bit more Googling on your own or quiz your CPA? Look up something called intangible drilling costs, or IDCs for short. We're going to be having more curriculum and education on this. So make sure you're a part of our group by signing up at thewealthelevator.com/club to get all these announcements. And a little bit ahead, we're going to be having a new circle group coming up for those of you guys looking for a little bit more community interaction. The way people are using these types of investments is taking advantage of not loopholes, but incentive programs that the IRS puts in there to basically they're trying to incentivize domestic production of oil and gas, which to get off foreign reliance of oil from the Middle East, etc., China, Russia, makes a lot of sense for them to do that. So they're going to be putting these nice tax incentives, but you got to know what to do, right? And you need to know where to go and invest. So just know that this is out there. Do a little bit more research. And if you have any more questions, feel free to shoot me an email on Lane at thewealthelevator.com.